Hello everyone, it's Mark Masterson with Hightower, Naples, and this is our Q2 video market commentary. Well, Q1 2020 was historic, as you all know, in many ways, and Q2 and Q3 may continue that trend as we work through the coronavirus and its impact on all of us and the capital markets and the economy, etc. Clearly, I have a ton to share with you today, so let's go ahead and jump right in. For those of you that saw my intra-quarter update a couple of weeks back, the four horsemen are going to look fairly similar. Let's look at fundamentals. We're bearish, clearly bearish. Q2 is going to be extremely challenging. It's going to be recessionary, maybe even depressionary, depending on how GDP and earnings evolve. And that's because of the sudden stop that we experienced with coronavirus virus around the world. So fundamentals look awful. Technical analysis also bearish. The charts are kind of a mess at the moment because of the quick decline across equity assets and the quick rise across bonds, things of that nature. We're going to need more time to heal, and we're going to be taking a look at how the markets can recover from where we are today. I'll cover that later. Sentiment, bullish. I added neutral. A week ago, we were raging bulls based on sentiment because, we had seen multi-year, even decade lows in terms of sentiment. That kind of changed last Monday. We were at peak panic. And then 5 days later, people were panicking about missing a bottom. So that's how quickly sentiment can move. Still pretty scared out there. Still, I would say it's still bullish, but not quite as bullish on the sentiment side as it was. And then policy, what can we say? We're going to talk to you about that. But, the Fed has gone nuclear. Central banks around the world are going nuclear. The fiscal policy is nuclear. There's just nothing else besides policy response going on from the Fed and on the fiscal side. So we'll cover that as well. So that's what the four horsemen look like today. And when we entered the year, if you look at my January commentary, you're going to see these were our themes. Late cycle. I mean, we thought we were late cycle coming into this year, and now we know we are. Cycle's over. Fed and central banks and liquidity. Our theme then was they were going to need to stay in the game. Boy, is that the case today. We know it's an election year. That's still in play. Sentiment we're going to look at. Big extremes and swings. And inflation, I just say not now. We're going to have deflationary pressures first, and inflation comes later. We're going to talk about these as we move through. So let's start with an executive summary of where we are. As I've talked to people the last few weeks, we've kind of outlined multiple outcomes that we're trying to navigate and manage risk through. And, we've been working through a very wide range of outcomes, from very, very bad to extremely good. And such a wide range can often be a challenge to navigate because all of the different possibilities are real. So let's take a look. I do think that the range has narrowed a bit because of the policy responses, and we've taken maybe some of the worst case scenarios off the table. So that's a good thing. So let's look at a positive bullish case quickly and a negative bearish case. So good case, bad case. The positive side really kind of centers on this, that less bad becomes the new good. So the news just has to improve a little bit. Still going to be bad news. We know the next month we're going to have some bad news, but as long as it becomes less bad, oftentimes that's enough, at least for markets. We need to see some improvement, obviously, with coronavirus and whether that's flattening the curve, testing increasing, immunity increasing, treatments, etc. We need a quicker recovery. It's possible, but I'm going to show you historically it's not likely. It's just going to take time. V's are not likely in this type of scenario, though they are possible. The fiscal response needs to buy time. So it's kind of like a patient. We put a patient into a medically induced coma. That's our economy. And the Fed and the fiscal response are the life support until we can get to the other side. We know our banking system's in better shape. That is true. And it's great to see the public-private partnership and the cooperation and the breakthroughs we're seeing in supplies and equipment and testing. It's just wonderful. So this is all involved in the bullish case. On the other side of that, though, we can't ignore the possibility that, some of these things don't develop the way we want them to. So, in that case, the headlines remain darker for longer, just a challenge. That curve that we see on coronavirus, we kind of we go to the negative side instead of the positive side of that. The economic recovery takes longer. People's habits don't change that quickly, and it turns into a U recovery instead of a V. We see the worst case scenarios in terms of the data. I'm going to show you some of that. Leverage becomes an issue. We did come into this recession in a very levered position, and that can create stress. Oil prices continuing to stay low. Now, I saw today, even as I'm recording this, Trump is trying to broker a deal with Saudi Arabia and Russia, so that could help maybe take some of the pressure off there and get a little bit of the recovery in oil. That'd be a good thing. And then this psychology can't be ignored. I mean, we remember 9/11, how long it took us to kind of get back to normal. We all felt differently after that, and we even imagined things that could happen that never did. And that could happen here too in terms of our ability to get back to normal. So these are just some of the things that we're looking at for clients and trying to navigate how we're positioning portfolios, how we're in terms of our plan to get things back to normal for all of you as clients, in terms of the portfolio positioning and timing. All of these things are what we're taking into consideration. So let's look at some fundamentals. These are the second quarter GDP estimates out there right now. They're all over the map, but they're all bad. Bloomberg's on the best case scenario at -9%. And then we have Goldman Sachs, Morgan Stanley, Capital down here between 30 and 40% negative. Huge variance here. It just goes to highlight the uncertainty that we're experiencing. But I will tell you, none of this is normal. This is not recessionary. These are some degree of depressionary in terms of historical data. And so keep that in mind as we consider what the next quarter or two are going to look like in terms of the economic data alone. Let me provide some context here on this chart from Hedgeye. So this takes us through different recessions in a time frame, and you can see these were some of the biggest on all of the recessions and depressions that we've seen going back to the 20s. These were the big ones: -12, -18, -26%. Well, did you remember what I just highlighted for you in terms of what we're expecting to see in the second quarter? It's on par with this. So keep that in mind. This is not normal. These are more normal recessions. I also want to point out duration. For many that are hoping for and expecting a V, the deeper the contraction, oftentimes the duration in terms of how long the recession will last can be longer. I mean, the Great Depression was 44 months, but 14 months, 9 months. Even normal recessions, as you can see here, 7 months, 12 months, 11 months, the average is 11. So it's hard to envision a V here where we get 1 to 2 months of down and then, growth comes right back. I mean, this is probably going to be a multi-quarter contraction. And let's take a look at some data points, because coming into this, jobs was clearly the bright spot. In fact, in January, clients, when we would talk about late cycle, clients would say, well, what would you be looking for that would tell you the recession has arrived? And, there's no magic bullet, but the two things that I kept pointing to were these two. And again, chart from Hedgeye here, but this shows jobless. So here we were with jobless claims coming down, and we were just sitting down here. And you can see in the past, right before these gray bars, these are recessions, we get a spike in jobless claims. Well, that's what we told them we'd be looking for. So here's where we are as of today. There's our spike. And this is no ordinary spike. This is 10 million in 2 weeks. Way past anything we've seen historically. So the gray bar is here, folks. And that's what we were looking for. Never imagined we'd see this, but it's here. The other side of that is confidence. So you can see, they would say, I'd show them this chart and say consumer confidence will drop right before the recession. And it's just the inverse of this, really. I mean, as jobs go, confidence goes. And here's what we got last week. Confidence plummeting. And this week will probably be no less. So clearly we're seeing a lot of stress. And that's showing up here. U.S. Economic Policy Uncertainty Index. Off the charts. This goes all the way back to the early 80s. I mean, we had a lot here in the early 2000 bear market, and we had some in here as well. But here's where we are today. It's just gone vertical. And one of the issues that is clear is how unprepared at the moment we are, and this leads to this decline in consumer confidence, because coming into this, consumers and small businesses don't have much of a cushion. In fact, as Hedgeye points out in this chart, 34% of all small businesses have less than 3 months of cushion. 21% have less than 1 month. And 53% of households have no emergency savings. And I saw a study the other day that said 67% of Americans have less than $1,000 in savings. That makes it extremely difficult when you enter a window like this due to coronavirus and the impact it's going to have on the economy. So what do we see? We see businesses tapping their lines of credit in commercial loans at a pace unseen, in 50 years. So again, you see the spikes typically at or around recessions. Well, here we go. Massive spike. They're trying to create liquidity, make sure that they have enough. So we know we're heading for a couple of quarters of difficult times. Particularly Q2 is going to be very difficult. Q3 should be negative as well, but not nearly the same. Coming back to recessions, I want to point out a positive. And again, this is another chart from Strategas that points out different recessions, how long they lasted. Again, I just want to point out it's rare to see one that doesn't last, at least 6 or 7 months. So a couple of quarters. Many of them last longer than that. Most importantly, though, the market will bottom before the end of the recession. On average, 4 months before the end of the recession, sometimes as early as 3 months prior, or even 9 months prior. I should have said first, 9 months. There's one case here in 2001 where after the recession ended, the market bottomed. So it does happen, but most of the time the market's going to sniff that out. And that comes back to what I said earlier about less bad. When the data becomes less bad, typically the market will start to see the end in sight, see the light at the end of the tunnel. Keep that in mind. So to combat everything I just showed you in terms of what's happening economically because of coronavirus, the Fed and other central banks and a fiscal policy has been put into overdrive. In fact, I keep using the term nuclear because that's just what it is. The Fed went nuclear. I'm not going to detail everything that they did because I cover it every day in the morning roundup. But we are in uncharted territory between the multiple programs they've put in place, the things they're buying, the Fed that is, the different types of bonds and assets, the lines of credit. The Fed's going to take its balance sheet up anywhere between $2 to $4 trillion throughout this process. In fact, this is just last week. What we saw, that over $1 trillion in 1 week that the Fed bought and added to its balance sheet. Which, to put it into a context, it took Ben Bernanke back in the 08, 09, after that period when they started the first QE program, I think it was in 2012. It took them about 6 years to do what the Fed did in 1 week. So I would say it's nuclear. And it's providing liquidity to our markets, our capital markets, and in some respects to the world at this point. And it's not just the Fed; it's our fiscal policy. I mean, we know the coronavirus relief package is big. It's $2.3 trillion. It's 10% of our GDP, which is big, and it's 2 times the size of what was done in 2008, 2009. And in fact, we're hearing that there's more coming. Again, nuclear. And that response is what's going to be what gets the families and the small businesses and big businesses in some cases through and bridge them through this next 2 to 3 months, which is probably the worst that we're going to see of the decline in terms of GDP and growth. An interesting note, Tom McClellan put this out the other day. I put it in the roundup, but I thought I'd share it here too. Regarding QE, what does it mean? Historically, first of all, there's not that much context. I mean, QE was invented by Ben Bernanke in 2012. You can see after 2009, we started it with a couple of different programs. It was in 2010 that it really began in earnest, QE1, QE2, QE3. Here's what it does for stocks. When QE is enacted, the market typically will rise. When QE is paused, the market pauses. At least that's the historical context. You see the rise, the market, the pause, the market struggles. Here, the market kept on rising. And then once they started doing this, and of course, now the coronavirus, we're launching another QE. The interesting thing is it's not good for bond prices. You can see down here as QE started, these are bond prices. Bonds rally when the Fed's not doing QE. When they start it, bond prices fall. Bond prices fall. Bond prices fall. Bond prices fall. So the part of the point is that we want to make a note here is that in time, as we work through this and as the Fed's doing their QE, it will eventually help the equity markets in terms of once this turn is made and we start heading higher. And it is likely going to send interest rates higher and bond prices lower. So let's take a look at equity markets. March Madness, that's what we saw. Some quick stats. From February 19th to the 23rd, we saw the quickest meltdown in history for a loss of 34% on the S&P 500. Then we had an almost 18% rally in 3 days. Best 3 days since the 30s. By the way, not a good time frame. Then, of the 21 trading days between February 27th and March 27th, we had 18 different days of 2% moves. 11 down, 7 up, most of them limit, as you can recall. The biggest one-day gain since 1933. The second biggest loss since 1940, exceeded only by the huge decline on Black Monday in 1987. For the first quarter, Microsoft was the only green stock, quite surprisingly, I might add. And we had the worst Q1 in the 125-year history of the Dow. How about oil? Only down 66% this quarter. So when I say it was historic, I'm not exaggerating. It was historic. So just take a quick peek at some of the technicals. This was a chart that I'd shown a few times in January, and one of the things I highlighted in this chart going back then was how I was concerned that the market was stretching so far from this red 200 weekly moving average. In the past, when we got that stretch, we always saw a decline, and I would comment that a decline would likely come. Never in my wildest dreams did I imagine we'd see it happen in 5 weeks. Nor actually break through that 200 like it did, and we're back at the 200. But my point is not to rehash that. It's simply to say that historically, that 200, that red line, that 200 weekly moving average has typically been a place where declines, it's like a magnet, but that also tends to be where they end. So, we saw it end here, we saw it end here, we saw it end about here, and here we are now. And I suspect, as oversold as we are, just like these other times, this is going to be where we do some work to finish off the decline and then hopefully be done with this. There's a similar dynamic in the NASDAQ. This is the NASDAQ 100 QQQ, same thing. So you can see in the past how many times this red 200 weekly moving average has supported it. Of course, we broke through it here in 08. Here, again, working our way up, came down towards it, and here. We haven't broken it yet. I suspect we will this time, maybe on a retest or on a break lower. But my point is we're sufficiently oversold historically, going back at least 20 years, where this could serve as a nice place to have a pause and begin a rally at some point here in the coming weeks. And I know this chart is busy. I've shown it in the roundup many times, but this is important because markets tend to bottom in 3 ways: a W, a V, or an ABC. A V is very rare. A V is what this looks like here, at least at the back half, where the market's falling and then it just goes straight back up. Very rare. And in fact, this was a V here, but it really wasn't a V because this was more of an ABC. Market falls, has a rally period. So here's the A, the B, and then the C. This, an ABC, is the most painful. V is the most rare. ABC is the most painful. W is the most common. You get a decline and then a rally and then a decline that will test, slightly break, or even end just above the previous low, and then you start to work your way up. This is our base case. A W, I'm going to show you why. ABC is the worst case scenario. V is the least likely scenario in terms of the recovery from here. So in a best case scenario, this is what it would look like. You get our decline, we kind of work this out, we get a rally up here, we chop around, we have a retest, and then we keep going higher. Now, time is the key. This is showing it over the rest of the year. We get a rally here shortly, then we kind of work through the summer, another decline. This could be compressed to just a few weeks or months we could get this, or it could stretch out longer. But this visually just gives you an idea of what we're talking about here. And I've been watching this too because we're trying to determine when this starts. This is kind of where we've been with this rally off the low. Nothing really happens until we at least can break this downtrend line. So I point that out. We got there, and then now we're kind of chopping around, heading lower again. So we may just end up retesting again here soon, and that's something that we're watching. Maybe this all gets compressed into a shorter time frame. Historically, this is a look at other, sell-offs and crashes. So 1966, 1970, 1980, and 87. You can see this is kind of the W. Very common. You get a decline, a rally. This one broke the lows to a new low, and then that was it. 1970, a decline, a rally. This time it didn't quite. It kind of retested but didn't get to the lows. So that's the better case scenario. 1987, big crash, rally, and slight break of the lows, and then a grind higher. And then in 2008, a decline, a rally, and then we went lower. That's kind of an ABC. But I need to point something out because, after the 3-day rally of last week, I kept putting this in the roundup to just, patience. Because bear markets have huge rallies. And, these are just two examples. But, here's the 2008 example. There were 6 different short trading days, 2 days, 1 day, 3, 6, 5, 5. But huge rallies. I mean, 19%, 11, 12. These are short, and I can tell you, every one of these was convincing. Every one looks like the bottom. By the time you get here, you're totally exhausted. They just wear you out, and that's what bear markets will do. So we really need more evidence. It can't just be a clearing rally of 4 days or 3 days. We need more than that, and we're looking at a preponderance of evidence, not just a couple of days of up. And over here in 2000 and 2002 was even worse. I mean, look at this. This was a multi-year decline, of course, but look at the rallies here. You were down 11, up 12, down 27, up 19, down 26, 21, 8, up 8, down 32, up 21, down 9. I mean, by the time you get here, I'll tell you, you're just exhausted. And that's when finally the market will proceed higher. So no scenario is exactly the same. This one's unique too, and we're going to navigate it. But we have a lot of historical context, and that's what we're trying to share with you in the roundup and in these types of videos. From a historical context, this was a great study by Chris Chiavaccio. I saw it the other day, and he looked at all of these different bear markets, and they all had one thing in common. These were big ones, and they all had reached a level of oversold that you can see here. You can see they reached this level of oversold of minus 30 on this RSI. And not everyone reaches that like we have this time. So that's what they had in common. The point is that I shared with clients the other day was that every single one of these retested the lows, and every single one of them actually broke the lows. Some of them didn't break them by much, only 2%. Others fell 38% once they broke the previous lows. So you see them, they come down, they bounce, and then they retest the lows or they break the lows. Every one of them. So keep that in mind. I think that's fair to say that's what we can expect this time, to at least test the lows. So patience is what's needed. But I will tell you this, and a little bit of good news, again, looking at bear markets here, and you can pause any of these charts if you want to take a closer look at the data. But when you have a bear market, typically the length of the bear, sometimes they're short, 1 month, sometimes they're long, 21 months. The point is that the average bear market with a recession declines 37%. I guess the good news is we've already declined peak to trough in this one before the rally 34, 35%. So some of the work, or maybe even all of the work, has been done. Keep in mind also the market typically will take up over 2 years, 30 months on average when you're in a recession and a bear market to recover those highs. So patience will be needed. But the point I'm trying to make is a good bit of the negative we've already seen it. And even though we'll retest most likely and maybe even break those lows, it doesn't have to be by very much. Some more interesting and good news. In terms of bad quarters, the first quarter of 2020 was in the top 5. In fact, if you look at the top 10 here, at minus 20, we're right in that category. I guess the good news is when you look past that, since 1950, the next quarter and then 2 quarters beyond that, we're positive most of the time. I mean, 2008 was the outlier with another negative quarter, and then it was positive 2 quarters out. But most of the time, we're positive 1 quarter out, and then the following quarter likewise. So a lot of that, when you get a decline like this in a quarter, most or a lot of the damage is done. Looking at a similar thing from another angle, and again, pause and review this data because some of it's pretty interesting. So when you have an S&P 500 quarter that's 15%, the drop is 15% or higher. There's been a number of them, as you can see. The next quarter, almost always, again, with the exception being 08, the next quarter always positive. 2 quarters out, always positive. The next year, except for this one, was very, very positive. So again, the preponderance of the evidence is positive. This looks at it from a 1 year and 3 year and 5 year perspective. I mean, the data's pretty good once you have a bad quarter like this. And how about this one? I thought this was when you have what happens after a big Q1 decline? Well, if you look at that here, the rest of the year, pretty strong in many of those cases. So the positive side is of what we've been through together so far in terms of the markets is that a good bit of the negative has been priced in. I'm going to throw in a few of the historical context of the decline that I shared in the roundup that I think are positive. So the 3-day rally that we saw last week was very strong. In fact, we had 3 days of 80% upside volume. And I tell you, that's pretty rare. A couple of times that's happened. One kicked off the mid-'80s bull market, which was a historic bull market. The second time kicked off the 2009 bull market. But every single time that we've seen that Strategas did a study here, and they showed that there have been 3 consecutive days of 80%. They're very rare. There's only been, 6 times that's happened. Every single time you can see where it fell, either at or near a bottom. It doesn't mean it was always the bottom. Here you had a rally and then a retest, like often happens. But you can see that type of explosive move tends to signal that you're near the end of the selling, and that's an encouraging sign. I'm also showing you how blown out, last Monday things were. I mean, in terms of oversold nature of things, we had the fewest stocks trading above their 200-day moving averages that we've seen, almost ever. It was the only other time we were near that was in March of 2009, which was the end of the 2008-2009 bear market. I'll point out here that every time you get a low like that, it goes higher every time, which means the market does want to move higher. But I will say, back here in 08, it took some time. And that's why I keep saying that time is going to be needed here. We're going to need time to heal. We may chop around, we may retest, but eventually we are headed higher. Another interesting data point in terms of historic volatility, this chart shows the S&P returns over the years, last 40 years. The red numbers are the intra-year drawdowns. So it does show you that volatility is normal, and even in good years. These are years that ended positive. Year to date, we're down 20% with the drawdown of 34%. Look at historically that 34% drawdown, over the last 40 years, it doesn't get much worse. I mean, we saw it here and we saw it here, and the year ended down 23, and this year ended up positive. And then obviously 08, we saw it worse, and that was a worse year. But and the 20% that we're down year to date, look how, over the last 40 years, look how seldom we had a year where the market closed down like that. Again, it was in 08, and it was at the very end of the bear market. So it only happens in bear markets, which we're in now. But I will tell you, the volatility does suggest that we're, in the range of where we're about done with that. Sentiment was crushed as of last Monday. The smart money, dumb money is just one of the many I use, but I showed this in the roundup how we hit a level down here that was lower, the lowest level of dumb money sentiment in history. It was lower than 18 in December. It was lower than 2008. So you don't get any lower than that. So sentiment was crushed. How about this? The CNN Fear and Greed Index. In January 2nd, it was at 97, extreme greed. We hit 1 last Monday and Friday before that. 1. That's the lowest I've ever seen it. I saw it in 2 at 2 in December of 2018. So clearly sentiment had been washed out and still pretty much remains washed out. We got the old Barron's covers indicator. It's kind of a contrarian indicator. Back in January we had Dow 30,000, and now we've pivoted to crisis playbook. And then Last week it was all red and black. And, Paul Montgomery, he created the magazine indicator. He used to say bright red and black covers were panics reaching their climax. Well, we had it here and we had it here. So sentiment was about washed out as it's ever going to get. So those are contrarian positives. I still would tell you, be patient. We need time. Because now we have to address the coronavirus and the path that's going to take, and the data, which I covered at the front end of this video in terms of the data and the actual recessionary environment. The market will work through that, and the market will rally before it's over, but we still need to work through it and take some time for the market to find its true bottom and begin to move higher. So wrapping things up away from the markets here, I'm just going to take a quick peek at real assets and currencies. No secret, we've shown this is the chart of the dollar. It got a little wacky here recently. We had a surge and then another decline. I think that's a false breakout. Our view has been the dollar's headed lower. I still believe that's the case. I think the Fed's going to kill the dollar with the trillions that it's adding to its balance sheet over the next few months and quarters. And a lower dollar tends to be good in time for gold and commodities. Gold's having a good year. Gold's one of our core holdings. It's going to continue to be, and we're going to increase our position. We already have, but we're going to increase it even more over time. Gold had its bear market. Gold's bear market here in 2014, 13, 14, and 15. I just saw a study. Gold had two major bull markets over the last 30 years. The first bull market, let me find the data here. Sorry, I'm not quite prepared. The first bull market was in 1971 to 80, where gold went up 2,000%. In 1999 through 2011, it went up 700%. And to me, it looks like it bottomed right back here in 2015, and it's kind of beginning a grind higher. So it's a core holding. We think it'll benefit from a weaker dollar. The chart, as we've shown you over the years in gold, looks good. It's a nice big 5-year rounded bottom, and it looks like it's going higher. And if you look at that chart from this is the same chart, just looking at it from a longer term. We had the bull and the bear, and now we think we're going to be moving towards higher highs. Another asset that could eventually benefit if we get inflation down the road, and I'm telling you, inflation probably coming on the other side of deflationary pressures of a recession, but commodities. I mean, commodities have just recorded their its worst 10-year annualized returns going all the way back to the Great Depression. So, I mean, they've just been horrible. But when, something that's oversold like this for 10 years, it's going to have its day, and that's what we're looking for. In fact, the relationship between commodities and stocks has never been as low as it is today. So this chart shows the S&P 500 in commodities. When this is going up, commodities are outperforming stocks. When this is going down, stocks are outperforming commodities. So clearly, we've had stocks outperforming commodities, but it has rarely been this low. So at some point, that's going to move higher too. And the only other thing I'll talk about, not too much, but it is an election year. And this was one of our themes for the year, so we can't ignore it. The election is in play this year. Historically, when you look at the data, anytime, and I've shown you this before, anytime you have a recession before the election, if there's no recession, the president, whomever it is, incumbent, gets reelected. If there is a recession, they don't. Recession 2 years before re-election? Nope. Only one, Coolidge. No idea what happened there, but for the most part, it makes it tough. And stock market, pretty good indicator. So if the market's up 3 months prior to a presidential election, 93% of the time, the incumbent wins. If it's down, they don't. It's a pretty good indicator. So is that going to be true this year? Nobody knows. This is unusual. I've said in speaking with clients as they ask about this, I think President Trump and his reelection really depends on how people view his response to coronavirus. And his approval ratings are still pretty high. So I think it's his election to lose, but historical data would suggest it's a much closer call than people might think. And of course, as we move closer to the election, that call is going to become important, because whoever wins the election is going to have impact on policy, tax policy, and many others. And the markets will respond. So we'll keep an eye on that as well. So that's it. I'm going to wrap up. Thank you. Thank you for being here. Thank you for listening. I know I moved quickly through it. I had a lot to cover, and most importantly, your time's valuable. So as always, feel free to follow along. You can go to the Morning Roundup, go to our website, you can sign up, or you can just email me or call me, and I'm happy to add you to the Morning Roundup if you want to follow along daily and get those emails. Most important, just be safe. Stay healthy. We'll all get through this together. And you know what? We're going to be stronger for it on the other side. So Dave and I and our team, we're here for you anytime. Feel free to call us. Thank you. Talk to you soon.